Here's what insurance agents won't tell you. 98% of term life insurance policies never pay out a death benefit. But before you think that means term is a scam, consider this. The average whole life policy surrendered early returns less than 1% annually after fees. So which camp has it right? The buy term and invest the difference advocates, or the whole life enthusiasts who swear by permanent coverage? Today we're cutting through decades of sales pitches and internet arguments to examine what the data actually shows about these two fundamentally different approaches to life insurance. This debate matters more now than ever. With interest rates finally rising after 15 years near zero, whole life policies are becoming more attractive to some buyers. Meanwhile, term premiums have dropped significantly over the past decade due to improving life expectancy data. But here's what's really driving the urgency. Most people make this decision once in their 30s or 40s, then live with the consequences for decades. Get it wrong, and you could be looking at tens of thousands in opportunity costs, or worse, leaving your family financially vulnerable. The insurance industry has a massive financial incentive to steer you toward permanent coverage, with commissions on whole life policies often 10 to 20 times higher than term. But that doesn't automatically make whole life wrong for everyone. Let's examine both sides with actual numbers. Let's start with term life insurance, and I want to address that 98% statistic head on. Yes, most term policies expire without paying a claim, but this isn't necessarily a failure of the product. It's often a feature. Think about it. If you buy a 30-year term policy at age 30, it expires when you're 60. By then, your mortgage might be paid off, your kids financially independent, and your retirement savings substantial enough that your family doesn't need a death benefit. The policy did its job by protecting your family during your most vulnerable financial years. The math on term is straightforward. A healthy 35-year-old male might pay $500 annually for $1 million of 20-year term coverage. That same coverage through whole life could cost $8,000 to $12,000 per year. The buy term and invest the difference strategy suggests taking that $7,500 to $11,500 difference and investing it in diversified index funds. Here's where the first major perspective split occurs. Term advocates point to historical market returns and say, if you invest that difference at 7% annually after 20 years, you'll have built about $300,000 in wealth while maintaining the same death benefit. They argue this approach provides both protection and wealth building, with complete liquidity and control over your investments. But whole life proponents have compelling counter-arguments. First, they question whether people actually invest the difference consistently. Academic studies on investor behavior suggest many don't. Second, they point out that whole life provides guarantees that the stock market cannot. The cash value grows at a contractually guaranteed minimum rate, currently around 4% for many carriers, regardless of market conditions. Let me present the strongest case for whole life insurance, because this perspective is often dismissed unfairly. Modern whole life policies from mutual insurance companies offer several benefits that term cannot. Guaranteed death, benefit that never expires, cash value that grows tax deferred, the ability to borrow against the policy at competitive rates, and participation in company profits through dividends. The dividend component is particularly important. While not guaranteed, top mutual companies have paid dividends consecutively for over 100 years. New York Life, for example, has paid dividends for 169 straight years, including through the Great Depression and multiple market crashes. When you include dividend payments, the effective return on whole life policies from top-tier mutual companies has historically ranged from 5% to 7% annually, not spectacular, but competitive with bonds and more predictable than stocks. Here's where it gets interesting. Whole life insurance enjoys unique tax advantages. The cash value grows tax deferred, you can access it through loans without triggering taxable events, and the death benefit passes tax-free to beneficiaries. For high-income earners who've maxed out other tax-advantaged accounts, whole life can serve as additional tax-deferred savings vehicle. But now let me present the strongest criticisms, because they're significant. The fees in whole life policies are substantial and front-loaded. In the first several years, most of your premium goes to commissions, administrative costs, and insurance charges, rather than cash value accumulation. This creates a massive opportunity cost early in the policy. If you surrender a whole life policy within the first 10, 15 years, you'll likely receive less than you paid in premiums. The investment component of whole life is also conservative by design. While this provides stability, it may not keep pace with inflation over long periods. The insurance company invests your money primarily in bonds and real estate, then pays you a portion of the returns while keeping the rest for expenses and profit. When you buy term and invest the difference, you get 100% of the market returns minus much lower fund fees. There's also the flexibility factor. Term insurance paired with separate investments gives you complete control. If your financial situation changes, you can adjust your investment allocation, access your money without borrowing against it, or redirect funds to other goals. Whole life policies are much less flexible. Significant changes often require policy loans or surrenders that can trigger tax consequences. Let me share what independent research tells us, and I'll flag where data is limited. A 2019 study by the Consumer Federation of America analyzed returns on whole life policies and found that policies held for 20 years or more averaged about 3.8% annual returns after all fees. This data comes from actual policy illustrations from major carriers, though it represents projections, not guaranteed outcomes. Comparing this to historical market data, and here we're looking at 90-plus years of S&P 500 returns, the stock market has averaged approximately 10% annually, or about 7% after inflation. However, this includes significant volatility, with some 20-year periods seeing much lower returns. What's particularly telling is data on policy persistence. According to LIMRA, about 25% of whole life policies lapse within the first 3 years, and nearly 45% lapse within 10 years. This suggests many buyers either can't afford the ongoing premiums or become dissatisfied with the product performance. On the term side, the Society of Actuaries reports that term policy lapse rates are much lower in the early years, around 5% annually, but increase significantly as policies age and premiums rise during renewal periods. Here's data that's harder to verify, but worth mentioning. Several financial planning firms have published internal studies suggesting that clients who actually implement buy term and invest the difference strategies do build more wealth over 20, 30-year periods than whole life buyers. However, these studies may suffer from selection bias.